have noticed major banking and non-banking finance companies such as Bajaj Finance, HDFC Bank and SBI Card witnessed a decline of up to 6% on November 17th, following the RBI's implementation of stricter norms for personal loans and credit cards in the form of higher capital requirements. In this video, we will understand about risk weights assigned by RBI on loans, impact of their increase on CET1, which banks and why are they impacted, NBFCs, why a double whammy, how the Nifty has reacted over the years. In our previous video, we mentioned how banks function by earning the net interest margin, which is interest earned from loans minus interest paid on deposits. However, important thing to note here is banks have to maintain a certain CRAR, capital to risk-weighted assets ratio, or CAR, capital adequacy ratio, whenever disbursing a loan. In simple words, they need to set aside some of their own capital to mitigate risk. As per RBI, this rate is at 9%. That means for every 100 rupees loan given, bank has to maintain at least rupees 9 as CAR. However, RBI still believes that not all loans carry the same amount of risk and hence are categorized as secured and unsecured loans. Now, as the name suggests, secured loans include home loans, gold loans, loans against shares, basically those which mostly have a collateral, so that in case the loan goes bad, there are still chances of recovery. And the second category, unsecured loans, as the name suggests, include personal loans, credit card loans and loans to NBFCs, which do not have a collateral and hence are difficult to recover if they go bad. Hence, RBI assigns risk weights to each type of the loans. For example, for home loans, the risk weights are 50%. Hence, banks need to maintain at least 50% of the 9% CAR. So for every rupees 100 loan disbursed, they need to maintain rupees 4.5. Whereas for personal loans, the risk weights are higher at 100%. Hence, banks need to set aside 100% of 9% CAR, which is rupees 9. So then, why should banks give personal loans? That's the catch. Rate of interest for unsecured loans are much higher than secured loans, leading to more gains from the unsecured compared to the secured. Well, even the data suggests that in the past few months, there has been a strong growth in the unsecured segment where credit card loans and personal loans have risen much more than housing loans. Thus, RBI has increased the applicable risk weight for consumer credit, credit card receivables and credit to NBFCs with immediate effect as per the announcements done on 16th November 2023. The risk weights for unsecured consumer credit has been hiked by 125% versus 100%, while credit card receivables would be risk weighted at 150% versus 125% earlier. Risk weight on exposure to NBFCs has been hiked by 25 percentage points in all cases where the extant risk weightage is below 100%. So, banks to maintain their 9% CAR will have to keep additional capital on personal loans and credit cards. Let us look at some data on which banks have a higher proportion of unsecured loans and are more likely to get impacted by this announcement. Unsecured personal loans stands at 7 to 10% of overall loans for SBI, HDFC Bank and Axis, but appears large for IDFC First Bank at 17%. Credit card loans are large for RBL, 24% of overall loans, but reasonable at Axis, HDFC Bank, KMB, IIB at 3%, 4% and 2.4% for IDFC First Bank, while negligible for the rest of the banks. Private banks seem to have lower exposure to NBFCs as compared to PSU peers. Another important term to know here is CET1, Common Equity Tier 1 Capital. CET1 includes common shares, stock surplus and retained earnings, other comprehensive income, common shares issued by subsidiaries of the institution, and regulatory adjustments. It's important to note that Tier 1 capital doesn't include depositors' money or other assets the financial institution have little control over. Now, as per Basel and RBI guidelines, banks need to maintain a common equity Tier 1 capital of 5.5%, 8% including 2 CCD. So when RBI increases the risk weights on loans, it is the CET1 which gets impacted, and as can be seen in the chart, on overall basis we calculate 50 to 60 bips CET1 hit for HDFC Bank, SBI, Axis and KMB. RBL and IDFC First Bank seem to be more impacted at 90 bips and 70 bips respectively. Now let us understand how the NBFCs are impacted. A double whammy. NBFCs generally borrow funds from banks and lend to the end consumers. With increased risk weights, banks will now charge higher interest, hence borrowing cost of NBFCs will increase. Also, NBFCs will now have to allocate more capitals as CRAR for each unsecured loan. Thus, their margins will be impacted because of this double whammy. Among NBFCs, Bajaj Finance is expected to witness moderation of margins and business growth. SBI Cards, given 100% book being unsecured, witnessed highest impact due to new regulation. And lastly, let's have a look at how the Nifty has reacted over the years whenever the risk weights have increased. In 2011, the RBI increased risk weights for banks by 100% for exposure to retail loans. This led to a decline in the Nifty 50 index by 10%. In 2015, the RBI increased risk weights for NBFCs by 50% for exposure to infrastructure projects. This led to a decline in the Nifty Bank index of 8%. In 2017, the RBI increased risk weights for banks by 25% for exposure to unsecured retail loans. This led to a decline in Nifty index of 2%. As these examples illustrate, RBI increasing risk weights for banks and NBFCs can have a significant impact on the stock market. Investors should be aware of the risk whenever making investment decisions. Hope you liked this video. Please like and share this video. If any query, please mention in the comments section below. Do subscribe to ICICI Direct YouTube channel. Thank you.
Investments in security markets are subject to market risks. Read all scheme-related documents carefully.